Welcome, everybody, to a new episode of Sparta Market Outlook.
Thank you.
A special one today. As you can see, we're filming. It's not just audio. We're all suited up for IP Week. And here we are in our London offices. And so very excited to be here and to do this live. So obviously today we have James. How are you, James?
Yeah, very well, thanks. Enjoying IE Week so far. And just to say, congratulations on the funding round.
Yeah, thank you so much. It was quite an experience, but we managed to get through. And look, we're very pleased with what the amount we raised, with the partner we have.
Yeah, well done.
So look, it's great times ahead. I couldn't be happier. And but yeah, today is not about the funding round. It's all about IE Week and what we've heard so far. But let's continue with introductions. But again, thanks so much.
Yeah, thank you too.
Neil, how are you?
Very well, thank you very much.
Having a good time at IE Week?
Had a good time, down to the pub a bit.
Yeah, a bit.
Of course. And great to be here. A little bit strange with the cameras, but
yeah.
I think we're already...
Yeah, we're definitely a bit nervous. But yeah. And Jorge, how are you today?
Yeah, very good. A bit nervous as well about the cameras, but so good the IE Week until now. And looking forward for the podcast and also to our event this afternoon.
Yeah, we have a big party tonight at the Bentley dealership at Berkeley Square. If you want to join, please don't hesitate.
Yeah, I'm looking forward to it.
So guys, obviously IE Week, a lot of everyone meeting from across the world, mostly at the pubs and, individual meetings and all that. I love to hear what you guys have heard so far from the market over the last 2-3 days in terms of, market sentiment, rumors, gossip, anything you want to share. Please, let's start with that. Neil, maybe you want to start?
I can go. So, I'd just like to have a chat with people about the broader sentiment. That's what I was doing yesterday. Mainly, so looking from a crude flat price perspective, from a global liquids balances, which is what people like to chat about, of course. My feeling is that the kind of consensus, if you like, is non-consensus. So there's people who are a bit confused and kind of lack a bit of a thesis for the rest of the year. And the problem is, of course, all the things that we've talked about many times before on these podcasts, right? There's the new Trump administration coming in. They're doing some things internally in America that markets are souring on a little bit at the moment. What are the impacts of tariffs or even just tariff threats and then taking the threats off? What's the impact going to be on global trade and macroeconomics for the rest of the year? And I think that markets are generally not responding so well anymore to the things that are happening around us. And that kind of is filtering through to, for example, oil price down a lot yesterday. US equities down a fair bit. Bitcoin exuberance has really come out quite a lot. Consumer sentiment is souring a lot in the US. And all that is impacting the oil sphere as well, right? So there are, of course, a few bullish people out there that I spoke to yesterday, but overwhelmingly a bunch of people who are trying to digest too many moving parts. And there's quite a few bearish people I spoke to yesterday as well, of course. So, a bit of confusion all around, I would say.
Okay, yeah, because when, you mentioned that there was no thesis, but, we spoke about this at the beginning of the year, at the end of last year. There was one sort of common thesis across the board, which was extremely long balances, and everyone talking about 1.5, 2 million barrels a day of excess barrels. And then suddenly in Q1, everyone is like, oh, we got it wrong, or maybe, and now we're going back to a more bearish view, or is that linked to the Trump situation?
I think, it seems to be more of a kind of deteriorating macro view now than it is about, let's say, pure oil balances. That's my feeling. So it does feel like the call for extremely long balances is being pushed out like a bit further down the line this year, let's say. Yeah. And I mean, if you look at the crude markets, it does look a little bit loose in terms of light sweets, which we'll talk about later, but nothing particularly weak from a spreads perspective. And of course, Q1's kind of weak for crude anyway, because there's turnarounds, which we'll talk about later. Sure. So it feels less about the kind of IEA balances that we talked about in previous pods, and more about just what's happening in the world around us,
Yeah. So that narrative that we had at the beginning, or that general narrative that the market had, on a balance perspective is actually not being confirmed for the time being, maybe or pushed back, as you said, but not to be confused with the current bearishness that is much more macro or, let's say, the Trump related, in the same way that we had a very bull Trump case over the last 2-3 months, now sort of fading as people are realizing that it's not going to be that easy, if you want,
Yeah, but there's just loads of different moving parts as well. So I spoke to many people yesterday who still very kind of, let's say, bullish on things like Iran. Like Trump's definitely going to take Iranian barrels substantially off the market. That could still happen, but it's difficult to trade that right now. You kind of just have to wait and see until the evidence is kind of overwhelming that that's going to happen, right?
Yeah.
So, it's more about the changing geopolitical, political, macro environment that has changed really rapidly in the last 2 months, we could say.
Excellent. And Jorge, what have you heard?
Yeah, I have a couple points. Had this conversation with some traders during these days. The first one is the the Red Sea alternative for the arbitrage to Asia. And we talk about it, especially talking about this was NAFTA. Because right now we have seen a very big downtrend, like $7-8 per metric ton since the beginning of the year. I remember the guy was telling me, what happens if right now the arbitrage come back to Red Sea?
Yep.
Because maybe we can see a drop going to $5 per metric ton. So it's something to keep an eye on. Probably we have to talk about it with Michael, our freight analyst. Yeah. But yeah, very interesting, and I think it's something to look at in the latest market. And the other point is Dangote. Many people are talking about it. I imagine that last year it was the same, and the previous one as well.
And next year
as well. So yeah, still a lot of rumors, but I had an interesting conversation. Like, should they start exporting to Latin America or somewhere else in the short-term future, end of this year? I think it's something speculative, but worth to keep an eye on as well.
Yeah, no, as we discussed before, I heard some rumors. To me, on a trade perspective, it just makes a lot of sense because they're producing a much better quality than the local quality. So it just makes sense to arb and to export and import the other one. They're Nigerian spec, but at the same time, politically, it's you did not build the biggest refinery in Africa to then export everything.
Good point. Yeah.
So let's see. As we've discussed many times in this podcast, this is going to be like a Venezuelan telenovela where every episode is like and something new happening, and when you thought it was done, then it comes back to square one. It's going to be messy.
Yeah, I agree with it.
And so therefore we'll be talking about it in 26 again.
Sure.
Yeah. And James, what about you? What is your gossip for the week?
Yeah, it's interesting actually. It feels like I've not really spoken about Dangote this week because on distillates it kind of feels like more of like a fait accompli. But I am interested when you mention the exports to Latin America, because already like from offshore Lomé, a lot of that middle distillates gets exported to Latin America. So it's a common flow. So I guess that will happen on middle distillates as well. But more back to what I've heard about. So I don't want to give away the punchline about what I'm going to talk about later, but maybe a slightly differing view when I spoke to other traders about where the market's going to move to from now. And also kind of continuing rumours about the second half of the year being quite tight on distillates around kind of autumn turnarounds. So yeah, that's kind of what I've been talking about.
Thanks for that, guys. So moving on, as we normally do, we cover every product. So let's start with diesel today, James.
Yes, please.
So we've seen that the market has rallied over the last 2 months, I would say, since the end of last year, early this year. But
yeah, that's fair.
I would say that, or what I've been hearing is that we're maybe at the cusp of a turning point here in the market. Is that what you think, and why?
Yeah, so I guess that is what I think, and that's kind of what I'm going to go on to talk about more. Let's talk about a little bit about how we got here. So we had weak margins kind of globally, leading to run cuts in Q3 mostly Asia, but Europe to a certain extent. And when we were talking about the views, or when the market earlier was talking about the views as we move into Q1, the kind of expectations is that all of that new additions in the Middle East, Al Zour, Duqm, plus Dangote, plus Dos Bocas, was going to lead to kind of a possibly bearish view as we went into Q1. But actually what's manifested and what's led to this positive run is that we've started the year with relatively low distillate stocks. So we've been on a positive run, as you say, since then. And I want to talk about why I think we're moving towards a kind of turning point as we move further into March. There have been some hiccups along the way, things that have been important to monitor in distillates. The US tariffs that Neil has been kind enough to speak about earlier, things like that. So we've got low stocks currently in pad 1. And as a consequence, the Hogo has been on quite a widening run, probably since the start of December. But actually, it's found a little bit of a ceiling of late. And even those pad 1 stocks are even relatively low, even in comparison to like pad 3 stocks, US Gulf stocks now. So although I think there's a turning point, I think there's still a little bit of bullishness to run. Although I want to be very, very careful there, because it's only when you look at the middle distillate complex now, only is it ice gas oil spreads and heating oil spreads that are still moving up. Kind of everything else has started to find a ceiling, giving more argument to that kind of turning point I'm discussing later. Now, weather's been an important factor in distillates. I guess that's always the case, but we've had like a colder winter this year. I suspect because we've come out of El Nino than we've had for probably like 3 years now, particularly in Europe, North Europe, the US, and North Asia, parts of it is now. And we've already spoken about the run cuts, which has also led to those stock movements as well. Now, because of this, because of really, like, and I mentioned it before, ice gas oil and heating oil pricing up, we've really seen the east-west widen over the last period of time. So I think the east-west now, if you look at it in kind of like a front month number, is probably the widest it's been, I think, in about a year, something like that as well. But it's interesting, why I was very interested in what Jorge was saying before, is that that's not been enough to point diesel Middle Eastern cargoes west currently. Actually, Jet 1's just about now point west and are actually open into New York. Another reason why I think it might be a bit of a turning point, actually, there's going to be increased jet imports west. But the east-west, I think, still has a bit more to go to pull these via Cape Middle Eastern diesel exports west. And again, just to not repeat myself, I was interested in what Jorge was saying, because actually, if you look at those calculations in terms of via the Red Sea Suez, then it is open west on diesel as well. So that could be a real trigger as well for like some bearishness in distillates when that arb essentially opens west again on diesel via the Suez. So it's important to monitor.
Well, that's a massive game changer, no?
It's a massive game changer, yeah. Also because
let's be honest, yeah.
It's also not just, well, I mean, as we all know, it's not also just that it makes the economics cheaper. It also makes it quicker that you can get those distillates west.
And it
as
makes
well.
Vessel availability
Turnarounds of vessels.
You know, you have more vessels available, and you know it's a vicious circle for freight. It gets cheaper, and therefore it impacts east-west. It impacts,
It's like a global optimization.
Yeah, it's a global optimization. Exactly.
Yeah, very good. Yeah, that's nice. Yeah, and I guess probably the main factor, apart from those, why I think there's a turning point coming now, is the end of US Gulf turnarounds or US turnarounds in general. We should see runs there increase quite rapidly from now. Northwest European turnarounds, or European turnarounds in general, are going to start or are kind of starting now. But from our analysis, Northwest Europe turnarounds are going to be relatively light compared to the last few years. Really, the kind of heaviest maintenance in Europe is going to be in the Mediterranean, which is typically a low demand point. And I expect that this east-west is going to have to continue to weaken, to widen even. Because Singapore diesel and spreads and cracks have already been weakening and showed no sign of rebounding again. So that's going to also help to open as east-west. We're going to see those ARBs, Middle East ARBs, open west or point west soon. And also the end of cold weather. I know there's like the feeling that next week is going to be very cold in the US again. But once we get past that, the turnarounds end, these ARBs point west again. I think that will be the turning point, and we should be able to start getting short this market relatively soon. Mid-March.
Yeah. Where is the March-April spread right now?
The March-April spread for heating oil is about 5.50 cents per gallon. March-April ice gas oil is 14.5, something like that.
That's a decent valuation.
Yeah,
you know,
it's pretty toppy.
No, because obviously all of this is relative in the sense that if the spreads were at 3. What you're telling me is not necessarily massively compelling, but when you're at 15, do you really want to be much longer here?
Yeah, precisely. How much more can it go, really? And where's Singapore diesel? I think March, April is $0.50 per barrel, something like that, 0.5, something like that. So still all backwardated, but I think the top, I guess.
It's good to hear you being bearish.
It's been a long time.
I really enjoyed that. I also agree.
Although he's always been cautiously bullish, you know.
Since August.
I'm always bearish diesel. But no, I like to hear. I think that's right. And I also think, just to add 2 things onto this, I still think there's a geopolitical element in diesel. and a nat gas element, right? So the weather is kind of like a twofold thing, right? It's heating oil demand, and there's a bit of a nat gas problem in Europe, as we've discussed.
Yep.
And for every sort of megawatt hour that you add on top of the TTF price, you're thinking about an extra bit of difficulty on your hydrocracker margin, right? So once the weather comes out, nat gas presumably will eventually fall once the weather gets colder, and we have to start refilling inventories. But I think a bit of this premium will come out of diesel as well. And the last thing to mention also is, if we look at the fuel oil market and the crude market, there is an implication for gas oil supply, right? If there's not enough resid, gas oil supply gets impacted again. And we think on the crude side, we've been saying it for weeks, we think that the geopolitical premium will come out of these things, and I think that will also impact the gas oil side of things as well. So let's see.
Yeah, it's a really pretty strong bearish argument. Also, one that actually I hadn't really thought about strongly before Rachel pointed out at our breakfast briefing this morning is that we're coming out of maintenance now, but also margins are really strong.
Very good.
So when they come out, they're going to be running hard, I would suspect.
Hope so, yeah.
Well, that leads me to crude.
Thank you.
Yeah, thanks, James, for that.
Yeah, no worries.
So we see a recovery on the light sweet market in Northwest Europe, correct?
Yes.
You want to start with that maybe, or?
Yeah, we can start there. So that was one of the, as we mentioned right at the start here, that's one of the things that, I guess that's the weakest point of the oil market almost, is the light sweet crude market, because gas oil's been very strong, NAFTA's been extremely strong, gasoline's been pretty toppy, fuel oil very strong, and light sweet crude seemed to be the kind of one weak point. And I think it's turned a corner. So there's two elements to this. One is the North Sea and one is TI, and we can talk about TI later. But since about mid-February, there's a bit of a turnaround, right? The DFL is one way of kind of measuring the North Sea strength. That bottomed out mid-February. It started to recover. And if you look at, let's say, price action the last day or two, flat prices come off a lot, but Brent spreads, for example, are actually rising. So they're strengthening. I don't think there's a very complicated explanation here. We've had turnarounds in Europe, and buying is going to start to reflect rising runs again.
Indeed.
And as we've been talking about for ages, the arbs to the east are super open, as open as we have seen them basically since we started our crude tool, which is already more than a year old, of course. And I was reading today, there's a 10-month high February exports of North Sea crude, which includes some Johan Sverdrup, which is a bit heavier, but there's also 40s included, is at a 10-month high to the east. That's exports. So, and that's several hundred KBD that doesn't normally flow. And that is definitely enough to, tighten up your North Sea market, marginally speaking, as well. So there's a bit more demand locally. There's a bit more export demand into Asia, as we've been discussing. And that looks to be, tightening up again. And so that's what I'm seeing. And the other aspect of this, which we were talking about again in our little breakfast briefing this morning, is the fact that the margins on light crude are now basically at parity with margins on medium and not heavy crude, but medium crude, the sour crude market. And that makes a difference as well, because at the margin, you get some refineries, basically, I'm going to top up on TI this month, or going to top up on 40s this month instead of whatever it is, Basra. So that all heads in the same direction. And it looks like now the weakest part of the oil market is starting to recover, let's say.
That's very interesting. And I never really thought it like that. And I appreciate you explaining it, because for a non-crude trader, these sort of quality differentials and the top-ups and, it doesn't come naturally. When you're thinking about WTI, well, it's open, but you need to think about the top-up and not just on a pure one-to-one basis, but more on a optimization basis, which, again, it's natural for gasoline as well. Yeah. But it's just that I don't know the dynamics for crude. So thanks for explaining that.
And there's one more there. Sorry, one more to add, right, on an optimization perspective. The strength of fuel oil is such that surely the margin on, let's say, taking a barrel of fuel oil versus the margin on taking a barrel of, let's say, even sort of medium crude just now, is much worse than it was, because fuel oil cracks are positive, and it's just simply one of those things. Everything points to a bit more crude generally, and it points also more to light crude at the moment.
And I heard there was something going on with Tupras. Is that worth mentioning?
Yeah, it could be, just as a sort of nuance there. So Tupras basically announced that they're going to stop taking Russian crude from February. And I think that amounts to something like 220 kBD of Urals. And that's another marginal factor, right? That's kind of Urals that isn't part of the kind of legitimate pricing of crude, let's say, at the moment. And that leads them to try to basically take other crude that is legit. So they're looking at, I think I read Guyana, and they're looking into the Med for Libyan grades. And, all these things tend to add up. So now we have 200 kBD more of demand that wasn't there before. And that's not nothing, right? The one thing against that is what's been making the market a little bit nervous, maybe overly so, over the last week, is the announcement that we might get more KRG exports out of Ceyhan.
Mm-hmm.
Okay.
So they've been shut off for the last year or two. And it could be 300 kBD out of that pipe, but it's probably not going to be. It's going to be considerably less because they will, it's already being produced, but it's being refined and trucked elsewhere into places in the Middle East, let's say. And so it might end up being, let's say, 100 kBD, if it happens at all, that actually starts to flow out. So Tupras, I suppose if it happens, we'll be looking at that kind of crude. Yeah. But I think it's concerned, this whole story is probably concerned the market more than it needs to in terms of the volume.
Yeah, but it does come as a surprise, especially now, no, that we're talking about the end of the war and,
It's not a coincidence, I reckon, right? The fact that we're talking about essentially Iraq exporting more crude potentially, although it all depends on their OPEC quota as well, right? So there's all kinds of negotiations to happen there. It's maybe not a coincidence, right? Because Trump is coming in saying he wants low oil prices, he wants OPEC to produce more. He might or might not go hard on Iran, but if he does, it wouldn't be a surprise if he convinces people to try to backfill the gap, right, to a certain extent.
Yeah, it's giving him the position of power to then go after Iran, knowing that you have a buffer somewhere else. And fair enough.
And that's why you can't also. I always like to think of it like, if he does manage to take out 1 million barrels a day of Iranian exports, OPEC have at least a couple of million barrels a day of spare capacity. Maybe not as much as people tend to say. People tend to say something like 5 million barrels a day, I think is less. But they can easily fill the hole if Iran does, let's say, stop exporting. And what is OPEC going to do in that case? Are they going to backfill immediately, or are they going to take advantage of the situation and say, I will backfill in steps and I will try to make it nice for me price-wise, basically, through the year?
And obviously, IPA week, we cannot not talk about WTI Brent.
Okay.
What's your call on that? What is your view?
So I think we made this sort of call 1 or 2 weeks ago, and I was not very convinced by it. I think I called it a fairly low conviction call that I think TI Brent needs to paper TI Brent needs to move at least to minus $4 per barrel and maybe past it. And that did work out. I'm not taking credit for it. I think, I'm not quite sure I understand it fully, but
back trader,
it did, whatever. It was a bit of a win. And now I think TI is too weak. So if we look at our tool, for example, TI is still as cheap as it's ever been against Murban. So much cheaper than Murban, for example, in the Far East. And it's looking pretty cheap in Northwest Europe. And one of the explanations for the fact that TI spreads in particular almost went into contango last week, since recovered, is the fact that US commercial crude stocks are rising. And that's basically it seems like, again, the only data point in the world where you can see inventories rising that much at all, because products are kind of tight. OECD crude in Europe and Asia, their crude stocks are kind of tight. US has been tight, but it's been building the last 6 weeks or so. And I think that's the only convincing explanation for why TI Brent or TI spreads were so weak and why TI Brent's now minus 4. But it's gone too far. I think, US crude runs are going to rise again relatively soon. And TI looks too cheap everywhere. So I just think I wouldn't like to be short TI, relatively speaking, right now.
Okay. Well, that's a clear market call. So if we had to summarize crude, with not being weak WTI, not being short WTI, but what are the other sort of market calls or positions that you would that you come to your mind right now for the next week or two?
Yeah, I'm not going to touch time spreads, so let's not do that.
Is that your widowmaker?
Yeah, exactly. That's yeah. Every time I mention that, I get it wrong. But it's also obviously it's so difficult to tell what's happening in the market just now in terms of all the headlines, what's Trump going to do, and all this kind of stuff. I still think the other one that we have is relatively bullish Brent versus Dubai, as we've discussed. I don't think the thinking's changed too much. The trade didn't work out. I mean, I think I called 2 weeks ago a specific month, I think it was April, Brent Dubai swap. I said, okay, it's going to rally another 30 or 40 cents. It didn't work out. I think it kind of gets dragged around by flat price volatility. That's one way of explaining why it didn't work out, I suppose. But I still think the kind of fundamental thinking hasn't changed. Loads of West of Suez crude is arbing into Asia. There's still a huge geopolitical, not a huge geopolitical premium. It's much less than it was, but there's still residual geopolitical premiums in the spot MEG market and fuel oil market. And I think that still needs to come out because all the evidence tends to suggest that these sanctions are not much of a problem for crude.
Yeah. Okay. Well, thanks for that. And moving on to gasoline. IE week, February, it's always the moment where, traders spend half of their time at the pub and the other half talking about March, April. Probably both of those things combined, actually. So by the time you finish the evening after 12 beers, your March, April story, you don't remember if it was bullish or bearish, but we don't necessarily have a market call. We've been discussing, Jorge and I, about it, but it's more around, let's go through the storyline, of what has happened till now. And then let's look at what could happen over the next months, or particularly over March, April, let's say.
Yeah. Yeah, as you said, it's in every conversation in the gasoline market, so we should talk about it. And let's look at what we've seen so far in the time spreads in IBOP. The March April remain very strong. We have seen a $10 per metric ton increase during the last weeks. Looking at the seasonal levels, it's close to the average, but it comes from a very low point, and is the only time spread that is strong. If you look at all of the others, like the very brown, first March went to contango, but it's almost over, and the back of the curve is trading lower. So the strength of the market just remains for the March April. That would be one of the points. And
but how do we get here? Let's go step by step. How do we get to this rally on the winter spreads? Let's say
first. I would talk about gas NAF. We come from a very strong downtrend in gas NAF, especially during the last couple of weeks, but it has been falling for the last month and a half, 2 months. Then we have the components. We have been looking at reformate. It haven't followed gas NAF very, very close, but the trend is similar. We have seen a very big drop, especially in light reformate, but also in heavy reformate. So all of this, we have already seen this drop in the components. And then we have, not especially about the March, April, but about like the overall European export options. We are seeing, or we have been seeing, a lack of alternative into the Atlantic basin. There were none in the east, but due to the gas NAF correction, we have seen Europe losing outlets in Latin America, and they are close to New York Harbor. And as we have talked in some podcasts before during this year, it's very relevant that the US Gulf Coast has been cheaper to Nigeria, with a very big difference for some weeks recently. And right now, looking forward, it's still the cheapest for the prompt delivery windows. And Singapore is then the cheapest one. So in any case, at current levels, Europe is the cheapest source of supply into Nigeria.
Europe is the most expensive, you mean?
It's the most expensive, yeah.
Yeah, okay. Yeah. Because otherwise we get confused. You probably already had some pints here, but let's go. Thanks for that. But let's just take it a step back, because we were in a situation where March was at record high contango, -7.5, something like that. And at that point, there's no point of being bearish. You're just being, you're either flat or bullish, and waiting for something to happen. And we were seeing that there was no arbs open. US was still the cheapest source of supply pretty much everywhere. But then suddenly the summer grade started to rally, and summer grade, no, actually the spread starting to rally. And one of the reasons we understood is essentially that refiners switched, and instead of producing winter grade, they started producing summer grade.
Yeah.
So as a consequence, you didn't really have that much winter grade on the tank. And the second thing that we saw is that there was this sort of contango arbitrage game going on, where in the contango in the US was deeper or wider. So people were actually moving summer grade F1 or reformate or alkylate from Europe to the US for them to store for summer. Okay, so it's not like a pool of cargoes from the US, but you're sort of arbing in advance those summer cargoes right now. As a consequence, then you had like this double whammy of, on the spreads going up, because you had not enough winter grade, and all that summer that was being produced was moving away from Europe going into the US. That's pretty much what sort of drove the market to where it was. But now we see that we are in a sort of toppish kind of environment for let's say the March, April at minus 28, which you said it was sort of market average over the last years. Is that correct?
Yeah.
Okay. So the question is, what happens now? And one of the things that you said is that gas naphtha has fallen quite dramatically, actually from 95 or something like that in March to 50 or 55. That's a significant drop.
No, it's a very big one. Yeah.
And generally speaking, gas naphtha is mostly led by gasoline. The gasoline is the strong leg of that spread. There's a story in NAFTA, and we'll talk about it, that drives the market right now. But there is no resistance from the gasoline bulls, if you want, because otherwise we would not be seeing this significant drop in gas naphtha. So that's a sort of bearish sign that there is maybe lack of conviction on the bullishness of gasoline on the one side.
Yeah, indeed. If you look at since the beginning of the year, like we have seen a much bigger uptrend in NAFTA. So NAFTA has been doing it better during the beginning of the year. I think a big reason is under the petrochemical prices dynamics. We are going to talk about it later.
So that's one thing. On the other side, I think that, so that's sort of like the sort of bear case for March, April, where it's running out of steam, let's say. I wouldn't call it a bear case, but it's just, you're sort of running out of steam there. There's no reason for you to expect some very strong bullishness there. But on the other side, and this is something that we were just debating about, is that we're seeing now that drop in gas naphtha has been mirrored in a certain way by the drop of reformate, etc., but not as much. Much. So currently, those blend margins, even for April, are negative.
Yeah, and we talked about it. I think a couple of weeks ago, that there was a threat that they will open, especially for E10.
Yeah.
And now it's not the case anymore. After the last drop during 2 weeks of gas nap, it's not the case anymore. So it's a signal, maybe not bullish, but less bearish on the European market.
Well, I mean, we were doing the math before, and we were looking at the blend cost of E5 in April.
Yeah.
Because again, so let me take a step back here. We were saying that refiners were producing mostly summer grade. That summer grade was piling up in Europe, but then started to go to the US. Okay, but there's still that is not bullish. That's just basically taking moving barrels in advance, and
like taking the money now.
Taking the money
from the future.
I like the way you say it. Yeah, taking the money now instead of later. Okay, but what I heard from most people is that that's basically a bit bearish summer, because you're not going to have any demand, or everyone is sort of piling up stocks.
Yeah.
A lot of summer grade being produced. But then we looked at the blending economics of E5 for April, and we saw that it was plus 14, plus 15, something like that. I mean, that's a not very bullish sign of, components are too expensive relative to gas naphtha, to naphtha, basically.
Yeah. And I think that, gas naphtha in this case could be like an advance. Well, it's paper, and then when we look at reformate and all the other components, it's physical. And usually the reaction is first on the paper, so maybe something that we have to track in the short term.
That's a good point. Yeah, so that's a signal that one should be looking at. Is that relationship between reformate and gas naphtha right now, and is reformate then following naphtha or not?
Yeah. The correlation was very high during the beginning of the year. Right now, they both are weaker, but it haven't, like the physical market haven't followed.
It hasn't followed as much. Yeah. So that's so again, we're not necessarily making a market call here because, maybe people have already put positions on or whatever, but it does seem like, the fact that gasoline bulls were not supporting that gas naphtha is a story.
Yeah.
But on the other side, we're seeing that blending summer grade is not working right now. So components are too expensive relative naphtha. So we need to see if they start following. But the other thing is that we're seeing now that the arbs are now starting to be open.
Exactly. Yeah, that's a very interesting point.
Into New York, yeah.
Yeah, I've talked about Nigeria, but I would like to talk about a different markets, because we've been talking about lack of competitiveness from Europe into Latin America. And if we look at our arbs forward, from the middle of March, Europe start to be competitive into some outlets like Brazil and other ports in Latin America.
Brazil?
Yeah, Brazil.
Because Brazil is mostly NAFTA.
Yeah. Well, but that's what we are showing. Also, Ecuador and Colombia. Ecuador and Colombia are like the ones with the higher margin.
Yeah. The non-oxy, high RON. Makes sense. Yeah.
But well, like the overall picture is that Europe is again competitive there, and it haven't been for a while. And as you said, path one. Right now, we are seeing during the last weeks. We saw it on the presentation this morning here on the briefing, but the net imports from US, overall global US, are very low. Net imports. They are exporting more than never compared to the seasonal levels during February.
Yeah.
Last 2 weeks of February, and they are importing less. So both charts are one above and the other below the historical levels.
Yeah.
So right now they have a neat final product, the arbor from Europe, but it's something that can change from March onwards, and that's supportive for the European market. So we have already also that point.
No, so again, the storyline that I was hearing all the time is that we're taking, as you said, the money now, and summer would be a bit disappointing, but NAFTA, and I really want to hear you tell me about the NAFTA story here, and because that's going to have a big impact on the economics, on the whether we, the potential bull run continues in as we move into April.
Okay.
So it's not, I would say, would you call it a mixed kind of environment?
Yeah,
it's not so clear cut.
Yeah.
Okay, interesting. Before we move on to NAFTA, let's talk a little bit about Asia, if you don't mind.
Okay, yeah, we can talk about East West. I think like the most insightful chart that we can see about East West is the seasonal, because we come from some months in historical lows.
Yeah,
looking at the last 10 years, and we are approaching the average, the historical average. I think like the main reason is the Beijing tax rebate starting in December 1st. After that, we have seen a strong uptrend on East West, and we have seen the highest Singapore cracks in the last year.
Yeah.
So the market during this beginning of the year, the strongest market has been Singapore, and we have felt it through East West. Right now, we have some fundamentals that point that we could find a ceiling. The first one would be the components. As we have seen in Europe previously, the components have, the drop in reference rate was before the drop in the back of the curve of IBOP. So sometimes you see an alert there. And we are seeing kind of that in Singapore. It's maybe just the beginning. We have to follow these prices, but there has been some correction on the physical side, on the components. The other one is Singapore now is less competitive into Mexico West Coast, into Rosarito.
Yeah.
In the short term, in the medium term, our ARBs calculator are pointing that they will keep that market, but in the short term, it's US Gulf Coast. And the other one, something we have seen at the beginning of this week, is Indian ramping up gasoline production for January. So this data points maybe to a ceiling on the East West.
Okay.
Interesting. Sorry, question. The Beijing tax rebates discourage the export of gasoline or gasoline components from China.
Yeah, exactly.
Okay, and that's why the East is priced up. Okay, thanks.
Yeah, exactly.
Which was one of the reasons why I was quite bullish East-West since the beginning of the year, and I've been, wrong for the better part of that first half, that quarter. So I'm glad to hear that I'm finally right. But but again, if you're wrong first and then you're right, you're wrong. You're just wrong. so thank God I'm not trading. Okay, now let's tell us the story about NAFTA. I'm very curious because a $50 per ton drop on gas NAFTA is quite significant in an environment where supposedly gasoline was bullish. So tell us.
Yeah. I think the best way to look at NAFTA market is to look at the time spread since the beginning of the year. Both markets, Europe and Asia, they are very, very strong. In Europe, the backwardation is higher than $14 per metric ton. So it's very, very high levels.
Yeah.
And something relevant is that the backwardation is higher in Europe than in Asia. That's not typical at all in the NAFTA market. And what's the reason behind this? Cracks have been doing it, have been very strong as well.
Mm-hmm.
But what are the reasons behind this? We have seen like the perfect storm coming from the demand. So December was very, very weak. We saw the lowest physical premium in Northwest Europe for NAFTA, for open spec. And the stocks were very low. The petrochemical activity was almost dead in second half of December in Europe. And then we have seen the spike in gasoline, all the gasoline cracks rising. And we have seen a very bullish petrochemical market in Europe. Not enough to make very good margins, but much better than the expectation. Ethylene and propylene has climbed more than $200 per metric ton each in Europe, while in Asia they have remained flat. So we have gone under this, like a better situation from the gasoline demand and a better situation from the petrochemical demand.
Okay. Thanks for that, Jorge. And what about East-West?
Yeah, in East-West we have seen a different trend. The market has been very, very bearish, but I think that can be linked to what I've just said about petrochemical. Petrochemicals are doing very good in Europe, and they are flat in Asia. So this has been translated into East-West, and we have seen a $7-8 metric ton drop since the beginning of the year. And I'm gonna finish with that. But if I would have to make a call on the NAFTA market, for me, time spreads are. I'm a little bit not very sure about what will happen because they have been very, very bullish. I see some signs of a ceiling, but it's hard to say that when a market is that strong. But on East-West, I really see a potential bottom because we have seen the first sign of petrochemical prices decreasing in Europe. In Asia, they remain flat. And also, Russia is exporting less to Asia.
Okay.
And the exports from Europe are also low on NAFTA. So at some point, Asia could demand product from the West, and at the current levels for East-West, the arbitrage is not going to work. So they would need to raise physical premiums and East-West paper.
And this is via Cape you're looking at?
Yeah. I'm just talking about via Cape. Okay. If the Red Sea would open, we would have to make a new podcast,
we need to sit down again.
To make all the numbers again.
Okay. So just to, for me to wrap this thing around. So we went from a historically low levels of petchem demand, cash dips in Europe in December to now, I'm not an expert in NAFTA, but $14 a ton seems like a pretty high number.
It's pretty high, very high. Yeah.
So in 2 months, and this is, just remind me, this is mainly because of what?
The petrochemical prices in Europe, and also the combined strength,
the petrochemical demand.
Better demand from the petchem side, and also the a strong gasoline market overall.
Okay.
During these 2 months.
That's quite a turnaround, yeah.
Yeah. I mean, if you look at on the time spread, it's quite big number, but if you look at the physical premiums, it's like 0 + 1 + 2. So we come from a very, very bottom, from a very low bottom at -10. So the market has recovered a lot during these 2 months.
Okay. Well, guys, the screens had shut down. So that's maybe someone telling us to shut up and wrap it up. So, guys, thank you so much. This has been, I think we can all say we were quite nervous to start with, but quite excited to have to done this. And actually, it feels more natural than when we do it on a Zoom. It's much more conversational, I think.
Yeah.
So I would love to do this again.
Definitely.
In person. Maybe we go to Vienna, for an OPEC, and
Perfect.
we sit down just in front of OPEC.
OPEC chat and a schnitzel.
Absolutely. What a perfect combination. Anyway, so thanks a lot, guys. It's been a pleasure. And to you were mentioning before that you've met a couple of guys at IP Week that wanted to join the podcast. So if anyone out there is listening and wants to participate, we have these two sort of shows. One is this one here where we talk about the market, but we also have guest speakers to talk about particular topics. Last week we had who did we have?
Julien Matonier.
Yeah, Julien. Yeah, exactly. Very good French accent. Yeah.
Gotta get this right.
So love to have more guests on the pod. So please don't hesitate to reach out, and please subscribe and like on Spotify, etc. So again, thanks, and see you guys very soon.
Yeah, thank you.
Thanks very much, guys.
Thanks very much.
Good stuff.
Cheers.